Greetings. This is Dan Gardner broadcasting from Los Angeles, California, and I'd like to welcome you to the presentation entitled Blockchain for Global Trade, a non-technical explanation. We're going to try and keep this discussion as brief as possible, so we will forego the long-winded introductions and get right down to work. To quickly run through our agenda, we will first define blockchain, then we'll move right into the application of blockchain to international trade in a section called Global Supply Chain Applications, 3 basic requirements. We will then present a use case for international trade. There are many, but we're going to present purchase orders as our use case. And then we'll talk about what's missing, what's needed at the moment to complete the blockchain ecosystem and make it real for international trade. We'll begin by saying that blockchain is an open source computer code that was originally developed for trading in Bitcoin, or what is more commonly known as mining Bitcoin. We will emphasize that blockchain is open source. That means it is not proprietary, it is not controlled by any single entity. In fact, users of blockchain can download the computer code and develop applications from there. To put it another way, blockchain is the underlying software that allows for the creation, encryption, authentication, and timestamping of the steps in a Bitcoin transaction. The trick for global trade is, how do we transition away from a singular application for Bitcoin and make it usable for multiple types of transactions across an entire international trade community? But as one can see, the idea of creating, encrypting, and authenticating transactions and being able to timestamp the steps in a transaction is fundamentally appealing on an intuitive level. Wrapping up the last bullet point on this slide, we are indeed talking about transactions, but transitioning away from a Bitcoin transaction to a multitude of different transactions found in global trade. In either scenario, be it Bitcoin or international trade, each step in a transaction is known as a block. As a transaction unfolds and the parties meet their obligations under a given transaction, the blocks are built upon one another, forming a chain. That is where the name blockchain comes from. Continuing along with this idea of the blocks that make up a blockchain, they all reside on what is called a digital ledger, or what is generally referred to as digital ledger technology. And what this digital ledger does is to identify transacting parties, buyers, sellers, banks, insurance companies, customs entities, etc., as well as authenticate and chronicle the transactions that take place between this multitude of international players. Ultimately, digital ledgers create an immutable trail that ends in the exchange of assets between a seller and a buyer. To wrap up the conversation on Bitcoin, the exchange of assets there is the actual Bitcoin itself. Moving into an international trade environment, the exchange of assets is what we've seen throughout history: the sale of goods or services in exchange for monetary compensation, for funds, for money. What we're really interested in is the underlying value proposition of blockchain. Remove Bitcoin from the conversation completely and just look at the underlying value proposition of blockchain. Open source technology, available to and usable by all parties in a transaction. The ability to identify parties, to encrypt a transaction, to authenticate the transaction itself, and to timestamp it. We can see at a basic level just how attractive this is to international trade. And what we're really interested in, to summarize, is that immutable trail, a blockchain that cannot be changed without the consent of the parties, terminating in the exchange of assets between that seller and buyer. As we look at the realm of international trade and all the different transactions that can take place, we're always going to want to look for 3 basic requirements to verify that blockchain has an application in a given area. In order for blockchain to create value in global trade, we need 3 things. And the good news is that they have long existed out in the physical world, the atomic world, long before the advent of digitization. The first is a smart contract. The second are business rules. And finally, to use the term we've seen multiple times now, the existence of a commercial transaction. that has an exchange of value, an exchange of assets. Let's dig a little bit deeper into this storyline. A smart contract is terminology exclusive to blockchain, and really what it is simply the electronic version of a commercial agreement. But a smart contract and the business rules or the terms of the smart contract both reside on the blockchain. We have a smart contract, we have business rules that again are the terms or the clauses of the smart contract. Thirdly, the transaction is the execution of both the smart contract and the business rules. The fact that the smart contract and the corresponding business rules reside on the blockchain is a very helpful component, very important to point out here. Why? Because the details of each block, as the chain is built, as the steps of the transaction are executed, they must align with the original terms, business rules found in that smart contract. If they don't, the blockchain cannot proceed. Conversely, because the blockchain is immutable, if anything that happened or took place previously needs to be changed, it requires the consent of the parties. That's the immutable component of blockchain. There are lots and lots of use cases for global trade. We're going to focus on a purchase order. And the reason why we're focusing on a purchase order is because it lends itself very well to these three requirements we just spoke of. But in terms of volume of transactions, purchase orders are probably the greatest amongst all of the smart contracts that take place in global trade. Why is that? Well, basically because the purchase order is a contract between a seller and a buyer. No international trade, at least international trade in goods, can really take place without a buyer placing a purchase order on a vendor or a supplier overseas. What does that purchase order do? Yes, it's a contractual agreement, but it lists all of the terms or business rules associated with the sale of goods. Product description, raw materials requirements, price, currency, Incoterms rules, last ship dates, payment terms, everything we see on a normal purchase order, but now digitized in the form of a smart contract. Third hash point here, the terms of the purchase order have to be carried out in the form of a transaction. Sending a purchase order is one thing. Agreeing to the terms is one thing. Executing on the purchase order is the third component that makes POs so interesting for blockchain. A purchase order is a smart contract. There are numerous other examples of smart contracts in global trade. For the purpose of saving time, we won't go into the detail of all of them, but think of things like an ocean bill of lading, which is a contract for carriage, a letter of credit, which is an undertaking to pay by a bank to a beneficiary. We could even construe a customs entry as a smart contract, an export license as a smart contract, an inspection certificate, insurance requirements, many use cases for global trade. The best one to illustrate the pervasiveness of smart contracts in global trade is definitely the purchase order. Wrapping up the conversation, we do want to say that there are some gaps in the blockchain story. There are some variables missing from the blockchain equation. There's lots of potential, but as it stands today, we're going to present 5 variables that need to be part of that blockchain equation. What's needed to make it real? The first, global technology standards. Just like the internet is based on the standards of TCP/IP, Transmission Control Protocol, and Internet Protocol, blockchain needs its standards as well. EDI, Electronic Data Interchange, has its standards that have been adopted globally so all members of the trade community can use the tool. Blockchain currently does not have a globally recognized technology standard that can be used by all parties. We need that. Equally important, we need application program interfaces that integrate multiple supply chain activities. The work that's been done today around ocean bills of lading, around letters of credit, really quite important. But that's a singular aspect of a broader international transaction. There are many components. In fact, in a single international transaction, we could see, or we would definitely see, a purchase order, a bill of lading, maybe a letter of credit, definitely a customs entry, perhaps an export license, an insurance requirement. How do we identify all of those requirements and bring them together in an integrated fashion to create even more value for blockchain? Perhaps what we might coin as a meta block, a blockchain of blockchains, where all of these individual smart contracts are brought together in an integrated fashion. We need APIs to do that. We also require a robust community of developers and service providers. There are many out there today. We need more. We also need pricing models that are easy to grasp and that can be budgeted for. If we think about the millions, if not billions of blocks that will be built around the world and the thousands and hundreds of thousands and millions of transactions that are out there, the cost on a per block basis would be a fraction of a penny. Whether it's a licensing fee, a per seat or per user fee, or a transaction-based fee on blocks, it has to be clear, easy to understand, and capable of being budgeted for. Lastly, we can't forget about what goes on out in the physical world, in the atomic world. Surely, blockchain as a digitization tool has the potential to be revolutionary. But how much more impactful could it be if we were able to integrate blockchain with the Internet of Things? Clearly, the Internet of Things is also a digital tool. But we're talking about the sensors that go onto products, that help to track goods across supply chains, or the sensors that go on pallets or ocean containers, or in maritime terminals, airports, customs bonded warehouses that allow for not only the digitization and the immutable creation of smart contracts and their execution, but also the tracking of physical goods across the supply chain. That requires the bringing together, the linking of blockchain with the Internet of Things. All right, well, that's it. Hopefully it wasn't too painful, bearing in mind that our goals were to define blockchain, talk about its application to global trade as it relates to smart contracts, business rules, and transactions, bring up a use case that at least legitimizes the concept, and then talk a little bit about what's needed. In that framework, we hope this brief presentation was well worth your time. We will say thank you, wish you the best with all your blockchain endeavors, and more than anything, stay safe in the balance of 2018. If you would like to request the 3,500-word white paper that inspired this presentation, just write to contact@tradefacile.com and we will send it to you with absolutely no obligation. Thank you again, and stay safe.